So how about the rest of our lives? What are we thinking about suitability then? Sadly, from here on in, things get less and less suitable. Not initially. When you're in college, I don't expect you to put any money away at all. College costs too much. When I used to do my college tours, I try to get people to buy a share or two of a stock. But college saps the living daylights out of you in so many financial ways. I now regard it as a total hardship to even contemplate savings. But once you are out in the real world, it's imperative that you save, preferably through a 401k plan, at work, or a self-directed IRA. I always prefer the latter because you can pick stocks, not just pick from options that your company forces down your throat. That your company gives you and you have to pay a fee. That's for another show. This is where you have to begin the mix, though, of index funds and individual stocks. There's too much risk in individual stocks to just put together a portfolio of them of your own choosing. So at a minimum, I am demanding that you put your first $10,000 beyond what you have from your first 20 years into an index fund, the S&P 500 being my favorite, as I mentioned before. Now, I know that some will argue with that. I see them arguing on Twitter. I don't care. I know the truth. The possibility of one really bad stock hurting your nest egg even as early as in your 20s is simply too risky for this guy. With an index fund, no one stock or even sector can do that to you. But with the rest of your money, I do like stocks, and I want you to be diversified. It's why we play Am I Diversified here when we can, where I try to explain what diversification is in a breezy way. It's why we created a club, the ActionAlertsPlus.com club at the street, to show you how to invest, the ones that involve my charitable trust. I say involves because the trust is only allowed to invest alongside club members when I haven't mentioned the stock. The restrictions are that great, yes, to protect you. But I can tell you that if you want in-depth work on the stocks we talk about on this show and almost daily updates about a lot of them with a once-a-week update of all of them, well, then ActionAlertsPlus.com, the thing I created, it's a way to go. I set it up because I always talk about buying homework. I tell you that you need to buy a stock, but then you have to keep up with it. Remember back to earlier in the show when I discussed how hard it was to do the homework? Those trips to the Harvard Business School library to study month-old research and microfiche? Now it's so easy that I have had to scrap one of my earliest tenets when I started TheStreet.com in the 90s. You no longer need to spend a couple of hours a week studying your stocks. You need to read the conference calls. You can Google articles galore. So many that you'll get sick of the process very quickly. You can have articles and research pushed to you along with charts that I would have only dreamt of at one point in my career. Or you can read what we write at ActionAlertsPlus.com if you own one of those stocks. Whatever makes you most comfortable to be able to take charge of your money. That's what I want. Confident, not overconfident. Remember, I want you to be a good manager of your money or a good client. I don't even have a preference. It's at this stage that it's important to know thyself, not myself, but thyself in terms of risk. Until you get to this age, I want you to take all the risks you can, whether you like it or not. In other words, I would like to think I have more knowledge of what you can tolerate than you do. But when you get to your 20s, all I can do is ask you to think about what you will do in a sell-off. Will you buy more? Or will you cut and run? Do you have the wherewithal to take a decline and buy more? Or does it sicken you and wish you had no exposure? Can you accept that stocks go down? Not a silly question given how they've gone up over time, but have periodic swoons. These are crucial questions that only you can answer. I would like you to take more risk in more individual stocks that have growth characteristics once you have put away that $10,000. That's my preference. But I would hate to see you commit more than 20% of your money, your mad money, to individual stocks. That would not be my preference. As you get older, I want you to capture more income by owning more stocks that pay dividends, perhaps add a fund that boasts of higher dividends than the S&P 500. But don't be too quick to do so. In fact, I would not advise you to do that until your 30s. Only in your 40s do I want to introduce bonds to your portfolio. By this time, you should have been able to put enough away that bonds, even lower earning bonds, will protect some of your invested capital. Now, in the old days, it would have been heresy to suggest that you don't start investing in fixed income by your 30s, let alone your 40s. The problem with that is twofold. Life expectancy. Many people are outrunning their fortunes, and then the lack of good fixed income alternatives that don't entail a ton of risk. That's why I favor higher yielding stocks to most bonds. Although I recognize as you age, most bonds do have that non-caveat emptor provision. You can and do get your money back. As you enter your 60s, it's easy to see how you can put up to 50% of your money into bonds and take bonds up 10% more each decade, as I mentioned earlier to a caller. But that brings us back to the notion of suitability. If you can't handle the risk, if you think the stock market is simply not as legitimate an asset class as it once was, because it's prone to such deep valleys or what in retrospect look like overblown threats, or flash crashes for that matter, then I think you have to decide yourself if cashing out or taking stocks to minimal levels is right for you. The bottom line, it's your life, not mine. So get comfortable with what you can live with. But risk, at least until your middle years, should remain a friend. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.